What is good, YouTube? It's your boy Only Trader Taflon Don back with another video, and we're going to continue down the journey that has been bestowed upon us, known as the Candlestick Trading Bible. And we're going to get straight into it, no time wasted. Let's get into it. So here we got our trading tactics, and let's read along. So when we identify the trend, uptrend or downtrend, and the level of support or resistance, and we find a pin bar near these levels, in line with the direction of the trend, the second step is to know how to enter the market based on this candlestick pattern. So according to my experience, the candlestick trading Bible, Unaruma, I don't know how to say his name, but according to his experience, there are different entry options when it comes to trading pin bars. It all depends on the candle anatomy, the market conditions, and your money management strategy. The aggressive entry option. This method consists of entering the market immediately after the pin bar closes without waiting for confirmation. This strategy will help you catch the move from the beginning, because sometimes the price goes higher after the close of the pin bar, and if you're not in the market, the trade will leave without you. Very risky, very aggressive, and it just depends on your trading style and how much risk you can hold and how much you can keep your composure. Because with this method of entering before your confirmations comes in, you never know what price is going to do. But if you have those early pre-confirmations and you've experienced the markets and you know that at certain points in time moves happen before the confirmations even come through, then I'd suggest you take the trade based off your experience and not off of anything else. So you got the example below. So it's on a downtrend, there's a support that becomes a resistance, and entry after the close of the pin bar setup. So next, the chart above shows an aggressive entry could help you out to execute your trade in the right time without being left by the market. And as you see, we took this trade because we had three important elements. The trend, the market is trending down in this case. We look for selling opportunities. The level, in this chart we had a support level that becomes resistance. A signal, a clear pin bar was formed after the retracement back to the resistance level. When you have these three elements in the market, you just place your trade after the close of the pin bar and your stop loss above the long tail. Your profit target will be the next support level in case of a downtrend. These three elements are quite enough for you to find high probability entries in the market. The conservative entry option, the strategy consists of entering the market at 50% of the range bar retracement. This strategy sometimes will work and it gives you more than 5-to-1 risk to reward ratio, and sometimes the market will leave without you. So this option will be for those who are trying to protect their capital a little more and they're not willing to make a risky move without the confirmations. So the disadvantage of this is that you might miss the move, but alas, that is a part of trading. At least you protect your capital as much as you can, and the risk to reward to me doesn't really matter. 5-to-1, 1-to-1, it's all subjective, because how many times is it really gonna get to your 5-to-1? You should be just planning to take advantage in between that 5-to-1. That's your target, but that's not the final destination, man. It might go 3-to-1, it might go 2-to-1, it might go 1-to-1. But at least if you have that 5-to-1, I get it. You have that big range for you to anticipate if price continues to move, and you can continue to manage your trade and continue to take out as much money as possible. So basically, you got another chart, and the illustration above gives us an idea about the power of a conservative entry. As you can see, this entry method helps us decrease our risk and increase our reward. The trade above has more than 5-to-1 risk to reward ratio. One trade like this every month is quite enough to generate a decent income if you are swing trading and you have a significant amount of capital. Don't let them cap to you. If you have $100 account, man, it's not gonna work for you. You'd be waiting just to maybe get like, depending on what you get, just to get like 20-30 bucks if you're risking properly, or to lose 20-30 bucks. So one of the drawbacks of this entry option is that the market sometimes doesn't retrace to 50% of the range, which will make you feel frustrated because the market will move to the profit target without you. There is no wrong or right entry option. They both work great, but with screen time and experience, you'll be able to decide whether to trade aggressively or conservatively. And with screen time, you can start as a conservative trader and become aggressive because you now have some form of confidence and form to carry you forward. So trading pin bars with confluence. Confluences happen when many technical indicators generate the same signal. This trading concept is used by the price action traders, us, me, to filter their entry options and spot high probability signals in the market. It doesn't matter if you're a beginner or advanced trader, trading with confluence is a must because it will help you focus on quality setups rather than quantity, and will enhance tremendously your trading performance. Confluence means combination or conjunction. It is a situation in which two or more things join or come together. For example, if we're looking for a pin bar signal and we need to find other factors of confluence to confirm our entry, we're not going to try to take any pin bar that we find on our chart. We're going to try to take a specific one, try to have confluences around that pin bar to say why we should take the trade, not just to take it because there's a pin bar. So the factors of the confluence are the trend. It's one of the most important factors of the confluence. This is the first thing that most successful traders look for on their chart. They look at the trend and try to trade with the trend and not against it. Because trading against the trend, it's a bit risky, and most likely if you have that 5-to-1 risk to reward trading against the trend, I can guarantee that like 90% of the times it's not going to get to your 5-to-1. Second, support and resistance levels and supply and demand areas. These major levels have a significant importance in the market because all big participants watch these specific areas. And these are the areas on your chart that you should have plotted out on your support and resistance. Try to stick to even numbers because most institutional and retail traders are going to be trading from even numbers, because it's going to be hard to identify price at 1.579821, but if you just say 1.579800, that's a good level, because they're going to most likely use even numbers, because using odd numbers is just going to complicate the process. Moving averages. I personally use the 8 and 20-hour moving average. This technical trading to access dynamic support and resistance, and it's a very important factor of confidence in trading markets. I personally don't use the moving average, however, but if you do want to use the moving average as that added confidence and dynamic support and resistance, if it goes with your plan and your strategy and you backtest and live test, go ahead. Fibonacci retracement tool. I use the 61 and 50 retracement to find the most powerful areas in the market. I do not use Fibonacci because I know it's already ingrained into the market already, and my trading does not need it. Trend lines. Drawing these lines on your chart give us an idea about the market direction and help us to find the important reversal points in the market. When you are analyzing your chart, you're not obligated to find all these levels to determine whether the trade is valid or not. If you can find just one or two factors of confluence that come up together with a good pin bar setup, this is quite enough to make it a profitable trade. But for me personally, I would like at least 3 confluences, 3 to 5. 5, I'm not hesitating. 3, it's subjective to what the confluences are. So you just have to always be on your toes, man. That's why you gotta be on the charts every single day so that your mind is always alert. So we got an example below, an obvious pin bar signal near support or resistance level in line with the direction of the market. So as we can see on the chart, we're clearly in an uptrend. We're making higher highs, higher low, higher high, higher low, higher high, higher low, higher high, higher low, just so that you can really understand why they say it's trending upwards. Then we have the moving average, and as you can see, price is respecting it, except here at the support level, and this is where the pin bar formed, clearly showing a rejection. That price is most likely going to continue moving up. Very long wick, and it closed bullish, so that's a very good indicator. Price is at a support. It already did a retest, so as you can see, there are quite a lot of confluences there that suggest that you should be taking this trade in anticipation that price is going to go up. So in the example above, we have a high probability setup with 4 factors of confluence. The trend, the market is trading up, which means that we have to follow the trend and look for a buying opportunity. The level, the support level is an important key level in the market. As you can see, price broke out of the resistance level that becomes support and pulled back to it. The signal, the formation of the bullish pin bar after the retracement back to the resistance level that becomes support. Another signal, the rejection of the pin bar from the support and the 20-hour moving average that acted as dynamic support. All these factors work together to give us powerful trading signal to buy the market. And I promise you guys, if you just put this into practice, you might not even need to buy a course, because this can be a starting point for your strategy, and from there, as you spend more time on the charts, you can continue to just adjust it up until you find exactly what works for you. And this way you won't need a mentor or anything, because when I see what's in this book is basically what you need to become a good trader. So here we got another example, and as you can see, we'll just break it down. The price is making higher highs and higher lows. It breaks above. I do not use Fibonacci, but it breaks above. It retests, comes to the support level, shows long wick rejections. The pin bar forms right here, bullish pin bar, and that is your confirmation to begin to take the trade. This long ass wick shows that there was a major rejection. You see how all the wicks are small. Then when it got your price tried to push down, but it rejected it. You know that this has now become a support level, so you know that from this point, most likely your setup is safe, because you're going to probably have your stop loss around here, and you can see that at no point in time did price ever come back down to this point, and it just continued moving up. So the example below shows 4 confluent levels that indicate a powerful trading signal. The first factor is the bullish trend, and the second one is the resistance level that becomes support. The third one is the 20-hour moving average that acts as a dynamic support, and the last factor is the pin bar formation near these levels in line with the bullish trend. If you adopt this trading concept, you'll completely change the way you perceive the market. You'll start trading like a sniper by waiting for the best trading setups to come to you instead of trying hard to make trades happen. So for me personally, I like to see big patterns form, and within those big patterns, I start to look for pin bars, bearish engulfing patterns as my confirmation to enter the market at that point in time. And for me, that has worked quite well. So just like that, that's 2 confluence, because price maybe will show a double bottom or a double top pattern, and within that, it's also going to give you a pin bar. It's going to give you a bullish engulfing, a bearish engulfing, which is going to confirm what you already started to see from the pattern that was formed. So let's continue. Pin bars, trade examples. So I'll give you some trading examples to help you understand how to use the trading pin bar candlestick pattern with the trend, and how to use the confluence concept to confirm your entries. So as you can see here, we got a chart, and price looks like it's moving down. and we've broken past the support. So now it's become resistance. Clearly you waited for the retest and waited for price to make the pin bar signal, identifying that as our confirmation in a downwards market. And the 21 moving average, as you can see, the price touched it and rejected it. The Fibonacci, I'm not sure about that because I do not use it, but the concept is there. This is the NZ USD daily chart. As you can see, the market is trending down. That's the first information we gather. After the breakout of the support level that becomes resistance, the price retraced back to this level and formed a pin bar candlestick pattern. The formation of the pin bar near the resistance level indicates that the retracement move is over and the beginning of an impulsive move is likely to happen. When you put the 21 moving average and the Fibonacci retracement on the chart, we see that the pin bar is rejected from these levels, which indicates that this level is very important and sellers are willing to push the market lower. Here in this example we have solid reasons to sell the market. The first is the downtrend, the second is the formation of the pin bar near resistance, which indicates the end of the pullback and the beginning of a new downward move. The third one would be the pullback itself for me, because most price action traders will wait for price to break out and then pull back before entering the trigger. The third reason is the rejection of the pin bar from the resistance level and from the 21 moving average. And the last is the rejection from the 50 Fibonacci retracement, which I do not use, but it is a very powerful tool. And I have seen other traders using it, such as Swaggy C, Daniel Savage, Mamba FX. So if they're using it, it shows that it works and it's been working for them from their results. So now we have another chart here, and it's just basically breaking it down into detail what happened previously. And as you can see, if you didn't see before, price broke past this support and closed. This will be another good confirmation because price closed above the support. It closed below the support, sorry. That's another very good confirmation. And this could have been an entry right here. Take your 10 pips, you come out, you wait for the pullback. You see a pin bar, and just like that, it's created a miniature pattern because it's come here and it's here, which forms a sort of double top pattern, meaning that there were two rejections, pin bar, boom, bam, bing, entry, you take your pips. As you can see in the chart above, our analysis was right because it was based on solid reasons to enter the market. This is the method that I want you to learn to be able to trade the market successfully. That's what you guys need to do, is you just need to find your confluences and your confirmation. Try to spot patterns forming, and once you do that, it's going to be much easier for you to take a trade. It's going to feel less like a gamble. So this is the method. Yeah. So the chart above shows two important buying opportunities. Let's just break it down quickly. Price was coming down, it rejected, and it began an uptrend. As you can see, began an uptrend, creating high highs, higher low, high high, higher low, high high, higher low, high high, higher low. As you can see, at many points in time there were pin bars forming continuously. And if we were to put this down as a level, this would have been a good entry point because price was going up, it did a little bit of a pullback, and then it broke its own highs. So this would have been a very good entry, but it would have been one of those entries where you'd have to be on your toes and watching the chart because you'd be waiting for it to break above, and once it's broken above, you're entering the market in anticipation that it's going to continue bullish for how many pips you're trying to take. So the market was trending up. The formation of the first pin bar after the retracement back to the support level was a high probability entry. What confirms our entry is the rejection from the 21 moving average and the Fibonacci. The same thing happens with the second pin bar that allowed us to enter the market again and make more profit. Trading pin bars in range bound markets. You can say that a market is ranging when price doesn't make any high and higher low and starts trading horizontally between a definable level of support and resistance. Once I see the market changes its behavior, I have to change my tactics and adopt a trading strategy that fits this new market condition. To confirm a ranging market, I have to look for at least 2 touches of support level and 2 touches of resistance. Very important, don't forget that 2 touches of support level, 2 touches of resistance at the least, and you know it's in a range, and you can clearly see that it's bouncing across those support and resistance levels and it's not breaking out. Maybe it'll have a little bit of a fake out, but ultimately it ends up going back into the range. So it's a very difficult pattern to trade because in ranges, price is just going up and down, as opposed to an uptrend where you know it's better to take buying opportunities, or a downtrend it's going to be better to take selling opportunities. So once I've identified the range, then it becomes very simple to trade it by going long when price reaches the support level and going short when price approaches the resistance level, in a simplified way. But it's not that simple when you're actually trading the range. So as you see, prices approach the key support or resistance levels. We have an opportunity to buy or sell the market. We just need to wait for clear price action setup, such as a pin bar candlestick. So as you can see, we're clearly in a range. There's this resistance that's formed here and this support that's formed here. So you'd be trying to get in here and here and here and here and here and here and here. And for me, this would be my key level and this would be my key level. And if I see prices ranging within here, I'm not taking the trade. Because every time I took a trade in there, I never knew which direction I was going to go in. So as you see, let's go to the next illustration. Sorry about that. The illustration above shows us 3 trading opportunities. Let me explain how you can trade them successfully. So in the range, price is going up and down, it's doing a slow dance, and a lot of pin bars are forming. So the first one is a pin bar rejected from the support level. You can place a buy order after the pin bar closes, or you wait for the market to touch the 50% of the pin bar range. Your stop loss should be placed above the support level, and your profit target must be placed near the resistance level. The risk to reward of this is very attractive. The second trading opportunity occurs near the support level, and you place a buy order after the close of the pin bar, and your stop loss should be below the level of support. Your profit is the next resistance level. The third setup is an obvious buying opportunity. As you can see, the market is rejected from the support level, and it closed with the bullish engulfing, made a pin bar, very bullish movement. As you can see, the market was rejected from the support level and formed a pin bar to inform us that buyers are still there and the market is likely to bounce from the support level. Trading from major key support and resistance levels is the easiest way to make money trading range-bound markets. Don't never try to trade any setup if it's not strongly rejected from these areas. The second strategy is about trading in the direction of the breakers of major key levels, or waiting for the prices to retrace back to the breakout point, and then you go long or you go short. So there's another example where we're in a range, and this is what I would like to see, where you wait for breakouts, you wait for a retest, and then you look for your trades. But that's something that will come with experience. As you spend more time looking at the chart, you'll see that this occurs very often, where price will come out and come back, and maybe if your stop loss doesn't have enough room to breathe, it's going to come back and hit your stop loss and then move in your direction. So you have to just always be aware of that your stop loss has to have enough room to breathe. So the figure above illustrates a range bound market. The price broke out of the support level and retraced back to the point of the breakout, and the formation of an obvious pin bar indicates a high probability signal to short the market. This is how professional traders trade ranging markets based on price action signal. So how to confirm pin bar signals using technical indicators? Using technical indicators to confirm your entries will increase your probability of the trade being profitable. I'm not telling you that you have to focus on indicators to generate signals, because that will never work for you. But if you can combine price action with the right indicators, you'll be able to filter your signals and trade the best setups. One of the best indicators that I use to confirm my entries when I examine a range bound market is Bollinger Bands. This technical trading tool was developed by John Bollinger to measure the market's volatility. Strategy is very simple, and we will combine it with our price action to identify the best trading setups. If prices are rejected from a major key level and from the bands, there's a confirmation that the market will bounce from these levels. So let's look at the charts. As you can see, I do not use any indicators, so I'm not really sure what's going on. But if you look at the chart above, you'll notice how the Bollinger Bands act as a dynamic support and resistance when the market approaches the upper or the lower bands. Price bounces strongly. So if you see that a pin bar is rejected from a horizontal key level and from bands, this is a clear confirmation to buy or sell the market. This confirmation strategy is very simple and will help you decide whether to take a trade or ignore it. Because trading is all about emotions, and sometimes you'll spot a nice pin bar signal in a range, but you'll find it difficult to make a decision. What you have to do in this case is just put your Bollinger Bands on your chart and see if that signal is rejected from the horizontal levels. Don't overthink it, execute. Just execute your trade, place your stop loss and profit target, and stay and wait and let the market do the work for you. So the daily chart above shows us how the indicator could help us execute our trades. With confidence, the false breakout of the resistance level that was made by the pin bar is a powerful signal to short the market. The trade was confirmed by the false breakout of the upper band as well. Remember that in this technical indicator, it's used just as a confirmation tool in range-bound markets. Don't use it to generate signals. Use it always in combination with the horizontal key levels, and you'll see how the strategy will affect positively your trading account. In conclusion, I recommend you to practice these strategies as much as you can before you open and fund your trading account. And with that being said, that'll be the end of the video. Just like to say much love. We made it past 50 subscribers. I hope more people come in and continue to engage in the content. Suggest to me any books with strategy, with psychology that you'd like us to go through. I think I'll come through with another series where we'll go into basically the main books that most retail traders talk about, and we'll just try break down and try grab nuggets of gold and information that's going to help us become better traders. And then from there on, we just push on and see where it takes us, man. With all that being said, peace and love.